Hello, everybody.
Good morning. Happy Friday.
So, lots have happened since the past week.
We should probably introduce ourselves.
Yeah. Edgardo, well, if you're watching
on
this,
Facebook,
come on.
you know. Come
Anyways,
on, dude.
Edgardo Ballantyne.
I'm still Scott.
You had an accident, man.
Yeah, I had a bad car accident.
Yeah.
Hit head on at FIP. Somebody was doing 50. I was at a standstill, and go Tesla strong, man.
Yeah, dude. The Tesla held on, huh?
Yeah, the car.
Big.
The car saved the lives. Me, my wife, one of my daughters. Scary crap. Which, by the way, full disclosure, everybody, my brain not really working right from the concussion. So just if I say something stupid, please ignore it. But scary.
Good.
Yeah, everybody's fine. Bumps and bruises. Nobody's perfect, but yeah. I mean, look, you go through. I've just said this to a bunch of people. You go through something like this. Your priorities in life get real clear.
Right.
You know what I mean?
Right.
All the stupid shit you think about, or stress about, or get angry about, is just meaningless.
Right.
So, yeah, man, good to be here.
Anyways, that's what we missed last
What's
time.
up, Mike?
So...
I'm taking you out for your birthday, brother. Had a car accident. I've been distracted, but anyway.
That's what we missed last week.
Yeah.
So that's a pretty good excuse.
It doesn't suck as an excuse.
And then what happened afterwards is that the market went berserk. And then now...
Starting last Friday.
Rates are extremely low.
Yeah.
So I just want to just kind of lay down what's happening in the market
Yes.
and why we're there, and then let's just get into actionable things like what can we do to take advantage of these rates.
Yeah,
right? Because everybody's saying rates are low, so refi. Well, let's talk about that.
Right. Different strategies when you shouldn't refi,
Right.
et cetera. So, all right. So, again, take it from the market standpoint.
Okay.
It's all about the coronavirus.
So it's all about the coronavirus, and that's one thing that I want to. And look, we do this all the time. I'm sure if you've watched the channels a couple of times, you've heard this. But look, it doesn't have to do with the fact that the Fed cut the rates. When the Fed cuts the rates, they're cutting the overnight rates for the bank. That doesn't really affect directly, at least, long-term interest rates.
Yeah.
Right?
How many phone calls did we both get going?
Oh
Hey,
my
Scott,
God.
what's my new rate?
What's my new rate?
Yeah.
Because immediately
Fed drops rate. I lose half a day of work
right.
explaining the markets.
So listen, what's really happening is there's a lot of fear about the economy. There's a lot of fear in the street and the stock market that we're gonna get into recession-induced coronavirus.
Right.
So coronavirus-induced recession. Sorry.
I meant what you knew.
So what happens is when people are very, very afraid that they're going to lose money in the stock market, when they see that the averages are plunging, they take money out of the stock market and they look for something that's somewhat safer, because at that point they're not really looking to make a lot of money. They're just looking to not lose money.
Yeah.
So they put it into things like bonds, into things like treasuries. As those prices go up, their yield goes down,
Which is
and
the
then
rates.
rates follow. So that's why we have the rates going down, and down.
Yeah.
Which, if you're looking at your retirement accounts, it's not so hot. But if you look into buying into the price of money, it's extremely
It
low.
is.
I mean, almost historically low right now.
We're this
We're
close.
right there, yeah.
Our mortgage-backed security bond market goes all the way back to February of 15.
Not even close.
And we're at the best levels there. So look, why is this fear going on? The fear is going on because supply chains are being disrupted.
Yes.
The turn time on my Tesla is longer because of what's going on with this. Microsoft has told all their employees to work from home. Amazon has told all their employees to work from home. Yeah, so, China obviously is massively impacted. So what they're saying is that supply chains are going to be impacted, and this is going to really impact the Q1 earnings reports that we're, a month or so away from hearing from people. And in fact, a lot of big companies have already lowered their forecasted numbers.
Yeah, and I think it's important. Look, why the context is important. It's important because, one, it's a better way for you to be able to follow it. And two, if this is really what's happening, it's going to linger for a little longer than just, hey, the Fed cuts the rates and that's it, right?
Right.
So what that means is even if you're not in the process of buying a house right now, even if you're just thinking about it 4 months out, 6 months out, it's still a great opportunity. You will still probably, as long as this continues in the trend that it's been, you will still be able to take advantage of this low rate environment.
Yes, but one thing, there's a big unknown. And look, you and I talk a lot about economic indicators, employment reports, and inflation and all this other stuff that can impact rates. But they're there's short term or they're longer term things that can't really throw us for a loop. Okay,
Right.
The trade war between U.S. and China, we talked about that. I mean, shit,
For a
all
year.
of last year,
Yeah.
because it could change at any time. And by the way, it did. And that's what people have to understand with this coronavirus. Okay, who knows? I mean, possibly next Thursday they come out with a remedy for it. I don't know that I see it happening, but it can happen. And the second that
Right.
happens, things could reverse in a quick manner.
Right.
The question is this: we're leading towards a recession. Okay, I've said all along that the current administration, keeping politics out of this, but the current administration will do everything they can, as all administrations do in an election year, because it helps them stay in office. Okay, it helps the presiding party stay in office. So that's going to happen. Obviously, there's things the administration could do to bolster the economy. The administration, however, cannot take away the coronavirus. So the question is the coronavirus impact strong enough to lead us into that recession, or does it end up just being a little blip?
Right.
So, yes, you probably are fine in 4 to 6 months, but you may not be. I was sitting with a client yesterday, and I said, look, if I were you, I wouldn't procrastinate a whole lot on this.
Right.
Because who the hell knows?
Right. But my point is, you should still start looking at the numbers, even if you think that you're 4 months out.
Yes.
It's still worth starting that process.
Yes.
Because while I think we're gonna be, in a similar situation 3 to 4 months out. I don't know about 5 or 6 or 7.
Right,
You know
exactly.
what I mean? So, I talk to a lot of people that maybe their lease is not up until, 2 or 3 months, and they say, well, let's have that conversation now.
Let's look at, and the other thing too, by the way, if you're out shopping for a home and you've been qualified, give your lender or us a call and find out how much you now qualify for.
Yeah.
Because whatever payment you want to make a payment of 12 or 16 or 1800 a month, whatever the heck your figure is, that's buying you more house today than it was literally last Wednesday.
Well, so let's talk about the how we can take advantage of this.
Yeah.
Besides the obvious, the refi, the purchase power. The purchase power is higher. So if you wanted to keep a payment now, you can qualify for more.
And let me give everybody some math on that, okay? Because I think that's important. 1 percentage point change in rate is about $70 per month per 100 grand. Okay, so we live in a market here in Southwest Florida. $200,000-$300,000 is common. So $140 to $210 per month, with a one percentage point drop in rate. We dropped about 100, like a point and a half.
Yeah.
So we're looking at a $300,000 house now. Is down. Let's call that $315 a month. $315 a month is another $60,000 in borrowing ability.
Yeah.
So at last Wednesday's rate, you qualified for $300. Today, you probably qualify for $360 for the same payment.
Right.
Dude, that's big.
That's big. That's
big,
really
man.
big. The other thing that we can take advantage of is down payment assistance programs. We don't talk about them very much, but down payment assistance programs, typically what they do is they will have a slightly higher rate. Well, today with this low rate environment, you can get into a down payment assistance program with a pretty good rate.
Yeah.
With a historically very low rate anyways.
With the same rate regular people were paying last week. Right?
So, take advantage of that. If your only problem, you have good credit, you have everything, but your only problem is you don't have the money for the down payment, I would still look into this because you might be able to take advantage of this. So,
Yes.
and now,
Let's
refis.
talk about refi
which is
strategies.
the big one.
And look,
First off, if your rate is 4% or higher, just call us. Let's have the conversation.
Yeah, you need to have the conversation. But I think we got to talk strategies because there's a big mistake people make. Okay, people come to me, hey Scott, my rate is whatever, 3.5, 4, 6, whatever the heck the number is. Okay, I want to refinance. And the first thing we have to understand. Okay, well let's talk about cash out next. For now, let's talk about rate term refis. Okay, the first thing I always ask people is, how's your cash flow?
Right.
All right, because if your cash flow is strained, then let's put you into a new 30-year mortgage. Let's save you money. I ran numbers on a client yesterday. They bought a couple years ago. I was able to drop mortgage insurance. They owed mid to high 200s. I said, look, I could do a new 30-year mortgage, save you $400 a month. I go, but we're now adding 4 years back to your mortgage.
Sure.
Okay, 3.5 years, whatever it was. So we got to understand that from a cash flow standpoint, that's important. Now, the 3-4 years we're adding to the mortgage, let's be honest, very few people actually keep a mortgage 30 years.
Or 26.
Okay, so, or 26, fair. So, real world, that may not be a thing, but it certainly needs to be a consideration.
Sure.
Okay, what I'm doing with a lot of people, if the cash flow isn't tight, is let's drop you. You have 26 years remaining. Let's drop you down to a 20-year mortgage. Okay, I did a loan for a teacher. And I dropped him, he had 28 years left on his mortgage. I dropped him to 20 years. His payment went up $53 a month, and I saved him $96,000 in payments.
Right.
And in his case, I really do think he's going to pay off that mortgage.
Right.
So there is a lot of sense in doing that. So if your cash flow is strained, get a new 30. If your cash flow is not strained, maybe look at a 25 or 20. Now, obviously, a 15 year is the best deal.
15 years, it's like under 3%.
Yeah.
It's crazy.
I mean, the rates are low in that, but very often you're looking at a 40% payment
You're getting a big
increase.
payment. And look, another thing that's worth doing, and I know we both do this, is if you don't know, let's put both loans side by side.
Always.
Let's see what you're looking at. And I would, what I'm starting to do with my clients too is let's put a 30 year with a scheduled payment to pay it in 20 years or in 25 years. That way, you kind of have the best of both worlds. Your minimum payment is very low, so you can keep that cash flow. But if you choose to, you can set up your payments to put that money towards the principal, and you're still paying it off early.
Yeah, absolutely.
And that's a good strategy because, people are concerned about, it's fine right now, but maybe
coming.
the recession or, sometimes it's tight in December because of the holidays. Well, that allows you to kind of play with that a little bit.
Look, when I refinanced myself last time, my wife and I did just that. We were cutting our payment down by like $500 a month. And I said, look, I could drop us to a 15, keep the payment the same, and we opted to go for the 30 for that exact payment flexibility. And I got to be honest, when Irma hit, I was pretty thankful I had that $500 cushion in my payment. Now, please understand, you don't really get a break in rate until you get down to the 15-year mortgage.
Right.
20 and 25-year rates are eerily similar to a 30-year rates, but I think there's a lot of sense in that.
And look, let's not lose perspective, right? At the end of the day, the rate is just going to affect the payment. A lot of times people get so concerned about the rate itself that they forget about the actual payment.
Right.
So what you're talking about, it's exactly right. A lot of people just fall in love with the idea of having an under 3% rate, and then they put themselves in a position that they're getting into a 15-year mortgage with a higher payment, which causes a lot more stress than just having a slightly higher rate. And a slightly higher in the 3%. That's crazy.
Right.
And having a much happier life.
Look, I was talking to a client. It was the exact thing, and they had college coming up, or college for their kids, and I'm on that path as well. I have one in college, and the conversation I had with them, I said, look, if going to a 15-year mortgage saves you here, but now you don't have the cash flow and you got to take out a bunch of student loans for your kids.
Right.
I'm not saying it's the wrong decision, but we can't have the conversation about the mortgage without talking about the student loans in that particular example.
Oh, so that's a perfect segue, right? Mm-hmm. Let's talk about other debts.
Yes.
So right now it's a great opportunity to do a lot of that debt consolidation that we talk about. Why? Because money is so cheap. You have the ability to, pay off some of, I pull a lot of credit for people that have high credit cards with very, very high interest rates. And, it's a good opportunity to refinance to the same payment or lower sometimes, but even if it's slightly higher, use that money that you take out of your house and pay off for all those credit cards. Sometimes car payments might have very high interest rates. Pay off for that debt, and then your overall cash flow, your overall monthly debt drops substantially.
Right. Yeah, and it has to be looked at. But look, on the other side of this, we got to be careful. Okay.
What's the negative?
Yeah, you can't be doing this again and again and again. You can't use your house like an ATM machine. That's gotten a lot of freaking people in a lot of freaking trouble over a lot of freaking years. So that is 3 freakings in one sentence.
Yeah, it's 3
strong,
freakings.
man.
Yeah, he had an accident.
What was I talking about? Oh yeah. So we got to be careful with it. But if done very occasionally and done intelligently and done in the scope of the big picture, that's why you and I, we work a lot with our clients. If our clients have financial advisors or accountants or whatever, maybe financial planners they work with, we always work in tandem with all of them. So we make sure that we're making decisions that, because you also got to factor in taxability with all this. So you got taxation requirements, you have maybe, all these other pieces of things, the long-term, short-term and long-term financial plans and integration, all of this comes into play. So it's important to look at the big picture. But in many cases, when you're done looking at the big picture, some sort of refinance makes sense right now if you own a home.
So, if you're qualified for a home, you might be qualified for more right now. And look, rates are dropping fast. So you might be qualified for more right now than you were last week, even if you just got pre-qualified. Number two, like I said, down payment assistance programs are very, very attractive right now, just because the rates are very, very low. Number three, if you're thinking about refinancing, guys, let's have a conversation. We don't require much to start having a conversation with refinancing. All we need is a conversation with you to understand what your goal is going to be and to see the last statement of your mortgage.
And without
pulling credit or anything like that, we can have a conversation. We can pull some numbers together. We can show you kind of like what things will look like to help you make a decision. And then number four, guys, look, one thing is the rates being low. It's a great opportunity to take advantage of this, but still keep this payment into perspective. Take advantage of the low rates. Don't just go seeking for low rates for the sake of seeking for low rates. Take advantage, consolidate that if that's your case. Drop that mortgage from a 30-year to a 20-year or even a 15-year, perhaps with the same payment. Let's take advantage of this opportunity. And like Scott was saying, this might be an opportunity that, I think is going to stay for a couple months. I certainly don't think it's going to be there for a long, long time. You think that it might even disappear any minute.
Who knows?
So let's take advantage. Let's strike while the iron is hot, right?
Yeah. Look, I did a debt consolidation refi for a client, just closed, and I was saving him about $700 a month. And I talked to him about speaking to one of my financial advisors, investing that $700 a month into into an appropriate investment. And dude, the long-term benefit of the two things combined was hundreds and hundreds of thousands of dollars.
Right.
So look, we just again look at the big picture with things. So that's what we got. Do we have any questions that have popped up or?
Well, last thing too is if you are under contract right now, we talk about the why things are happening because it's important, and that's really what we look at when we look at the market to see when we should lock your rate. Right? The difference from people, I know we both have a lot of people that got under contract last week and not locking the rate last week and waiting for this week has been huge for them.
By the way,
savings.
The vast majority of our competitors lock an application with no bond market analysis whatsoever.
Yeah,
and then they're locked in.
Yeah, we don't just talk about this because we think it's interesting, although we do. We talk about this because in things like this, it creates real savings for people.
Yeah.
Like real savings. I had the opportunity to talk to a client yesterday where I told them, hey, look, the rate dropped this much that your payment can now be $50 less a month, or you can bring $2,000 less to the table.
Right.
It's real
substantial. So look, if you're under contract and you're locked and the bank's not allowing you to renegotiate, give us a call. Take advantage of the rate. It would suck to close and miss this opportunity by a week.
For no reason.
Yeah, for no reason whatsoever. So, look, dude, lots of good information. We'll be back next Friday.
Yeah, just we'll keep you posted on this, and please reach out to us.
Yeah, reach out to us.
Call us, text us if you have any questions. Even if you're with somebody else, just shoot us what numbers you're looking at, and let's take a look at it.
Yeah, just DM us. All right, everybody, take care, stay well, stay safe, wash your hands, and I'll talk to you soon. Bye bye.